Happy Friday out there, Team 42. It's your skipper here, Darius Dell, to present our macro minute for Friday, August 1st, 2025. It's the first Friday of the month, so you know what that means. It's Macro Scouting Report Friday, so we're going to have a lot of fun this afternoon educating our clients on the full distribution of probable economic and policy outcomes and how that is likely to create both upside and downside risks across asset markets. But before we get into that, let's get into our executive summary here. Today's key macro question is the Fed making another policy mistake? Our answer, yes, we believe the Powell Fed may be in the process of making yet another policy mistake. Ironically, to protect Jerome's legacy from their previous policy mistake of supplying historic monetary largesse amid equally historic fiscal largesse. The stark change in the Fed's reaction function from the Biden to Trump administration and the pivot in how the Fed views the impact of tariffs upon inflation suggests a degree of politicization is already present in U.S. monetary policymaking. This increases the probability of an erosion of Fed independence over the long term. With respect to the short to medium term, another Fed policy make increases the probability that asset markets respond poorly to our U-shaped economy thesis by pricing in a growth scare over a short to medium term time horizon, especially considering that our crowding model recently generated a bearish signal for the S&P 500. Regarding the U-shaped economy, the June PCE report, July ISM manufacturing PMI report, and July jobs report each provided support to the thesis. The U-shaped economy affords the Fed a window in which to lower the policy rate, not cutting with tightened financial conditions during the upcoming seasonally weak period for asset markets. Transitioning to our 42 micro dashboard, as always, we wrap up the question from our community. This one's somewhat of a question, just a couple of comments I'd haul out and then I'll unpack the comments. So we got a comment linking a couple of YouTube videos from our friend Jim Bianco over at Bianco Research. How you doing, Jim? Jim was making the case, which I generally agree with, that if we saw politicized rate cuts pushed through either by the Powell Fed or any other Fed, what would ultimately happen is you probably see a backup on the long end of the curve as markets rush to price in higher inflation expectations, higher term premium, high inflation risk premium. That is all true, and this is something we've been warning about, in the context of that risk. But what we've also said the entire time, and where I think we've had a variant perception relative to consensus, and now it's hitting the tape this morning, today, our variant perception was that, hey, if they actually should be cutting the policy rate, they should be cutting the policy rate, and the bond market is not going to react poorly to rate cuts that are actually worthy from the perspective of the economic data. We wrote an op-ed that, shockingly, not a single news source picked up. I thought it was an incredibly well-written op-ed that is explaining everything that's happening in markets this morning, global financial markets this morning, and that was on Wednesday evening. In our op-ed, we made the point that there was a highly credible case for a rate cut at the Fed's July meeting, and ultimately we saw that hit the tape in spades this morning in terms of the adverse reaction to the July jobs report. There is something to this kind of moniker of Powell being too late. Powell was too late to pivot in Q4 18 when the markets crashed. Powell was too late to pivot to recognize the impact of COVID. He was too late to pivot in terms of turning off the QE spigot and starting to hike interest rates back in early 2022 when inflation was already at a multi-decade high back in 2021. And now you can make the case that Powell is too late to pivot here in terms of supporting the economy with incremental rate cuts. This concept that tariffs are suddenly, going to trigger some sort of wage price spiral. I mean, this is like terrible monetary policy making. I don't want to be too critical because it's not my job to be critical of the Fed. It's my job to keep our clients on the right side of market risk. And with respect to keeping you guys on the right side of the market risk, we've been calling for some volatility in the summer months all year, most notably as a function of what is likely to be some adverse policy responses to adverse tariff negotiations. Tariff negotiations have actually gone quite well, and so it's kind of reduced the amount of left tail risk, near-term left tail risk associated with that dynamic. But the reality is, as the risk associated with tariff negotiations has gone down, the risk associated with the Fed making a policy make has gone up, way up in our opinion, as we talked about in our op-ed on Wednesday, our unpublished op-ed on Wednesday. The thing I would say is, I would say wrapping up, we still maintain our resilient economy theme. We don't see anything that's, materially changing in that. we're just in the part of the U-shaped economy that we've been calling for months now that is going to feel bad. It's not going to look good from a data perspective. It's going to feel bad. And if the Fed's not playing ball, it's going to tighten financial conditions because the markets are already pricing for the Fed to cut the policy rate. So, this is how policy mistakes are made in real time. And I think the Fed may be on their, they're they're well underway of possibly making yet another policy mistake. So, in our opinion, this man's term can't end soon enough. And obviously, that's an opinion that's shared by the administration, which, in our view, over the long term, we're going to see an erosion of Fed independence, partially as a function of the fact that they are already proven to be quite politicized, just in support of the previous Biden administration and Democrat regime. And so this is not good from the perspective of the, kind of where long-term policy is headed from the perspective of the U.S. dollar. But again, anything that's long-term bearish for the U.S. dollar is bullish for all the assets that we feature in our case portfolio construction process anyway. So stay tuned for this. This is going to be quite a story over the next several quarters in terms of the transition from the current policy mistake that the Powell Fed is insisting on making to, where Fed policy is likely to be, let's call it a year from today. So we'll wrap it up there. As a reminder, we have our August 2025 macro scouting report coming out this afternoon. Super pumped and super fired up to get into that. So I know our clients are going to appreciate those data-driven insights as they always do. So everyone have a great weekend. We'll catch you back here on Monday. Cheers.